Welcome back to the deep dive. Leonard Cohen famously said, there is a crack in everything. That's how the lake gets in. And for today's deep dive, that crack isn't some kind of flaw. It's actually, well, a deliberate financial signature. It's hidden in businesses that, on the surface, choose to look maybe a little underwhelming.
Exactly. We're digging into this idea called scaled economies shared, or SES. Nick Sleep really popularized it. See, most businesses, they scale up and they want wider margins, right? More profit per sale. But the SES model flips that. As they get bigger and their costs drop, they give every bit of that saving back to the customer. It creates this really powerful cycle. Loyalty, more volume.
Yeah, that's the paradox, isn't it? It's fascinating because investors are usually trained to hunt for expanding margins. That's the sign of success. But with SES, the management deliberately says no to that immediate profit boost. So they can end up looking, structurally weaker than their competitors because they're playing a much longer game. It's about dominance down the road, not the next quarterly report.
Precisely. So our mission today is to figure out, what are the financial fingerprints? How do you spot this strategy in the company's books when it's designed to be sort of not obvious?
Okay, let's get into it. What's the first pillar, the first major clue?
The first, and maybe the most direct fingerprint, is what we're calling the gross margin anchor. If the whole point is sharing the benefits of scale, they're just not trying to squeeze maximum profit out of each transaction. That's stability in gross margin. That's your first big clue.
Right. So say they get huge buying power, their cost per item drops.
Yep.
They don't just pocket that difference and make the margin fatter.
Nope. They pass it straight through. Lower prices for the customer. So what you look for is really stable or maybe even gently declining gross margins over 5, maybe 10 years, even while revenue is shooting up. Costco is the textbook case here, isn't it? Famous for capping their markups internally. That stability, that anchor, it's management signaling their commitment.
Okay, so the anchor is set at the gross margin level. But that makes me think about the next step down the income statement, the operating margin. If gross margin is flat, you'd expect operating margins to be kind of low too. But why might they actually shrink sometime, especially when the company's growing fast? That sounds like, well, like a big problem. The ultimate crack you mentioned.
It does sound like it. And it is the ultimate crack, but it's often a deliberate, strategic one. That contraction often happens because they are just aggressively reinvesting everything. Every penny saved goes right back into making the customer offer better. Maybe it's faster logistics, better service, new warehouses. They're basically choosing volume, velocity, over profit per sale in that moment.
Okay. But that raises a tough question, doesn't it? How long can investors really put up with a strategy that keeps, say, no-cap margins, net operating profit after tax, so low perpetually? Doesn't that make the company constantly dependent on borrowing money or issuing stock because they aren't generating huge profits internally to fuel that growth flywheel?
That is absolutely the tightrope they walk. It's a huge strategic challenge. For it to work, the successful SES company has to build such overwhelming market dominance, such intense customer loyalty, that investors trust the payoff is coming eventually. That low no-pat margin. It's almost like a structural wall they build. It signals, hey, competitors, we're barely making money here. Don't even bother trying to compete. Strategic poverty, you could call it.
Okay, so intentional poverty on the margin front. How does that constraint then change how we think about efficiency? Which brings us, I guess, to the third pillar, which sounds a bit more complicated, the turnover puzzle, specifically capital turnover.
Right. Capital turnover, sales divided by invested capital. Now, intuitively, if a company's scaling like mad, you'd think capital turnover should just keep climbing higher and higher, right? More sales, bang for your buck. But it's more nuanced than that. It really depends on the type of business we're talking about.
Okay, let's break that down. What about the capital-heavy scalers first? Like big retailers, manufacturers, companies needing lots of physical stuff.
Yeah, for them, the turnover chart can look a bit like a mountain range, lumpy. You'll see these periods of amazing efficiency gains. Turnover shoots up as they squeeze more out of their existing warehouses or factories. But then management looks ahead, sees the next decade of growth and says, okay, we need to build. And they spend billions on a massive new distribution network or a giant factory.
And that huge spending, that new capital investment, hits the balance sheet immediately, right, before the sales catch up.
Exactly. So the capital base swells, and temporarily it swamps the sales number in the ratio. Turnover dips, sometimes sharply. But for a true SES company doing this, that dip isn't a sign of failure. It's foresight. It's the cost of digging the next phase of their competitive moat. So when you're analyzing these, you actually look for those deliberate lumpy dips. They signal big, long-term strategic bets followed by periods where they efficiently fill that new capacity.
Okay, that makes sense for the heavy guys. What about the flip side? The capital light scalers, software companies, online marketplaces, where you don't need a new factory for every new customer.
Here the fingerprint is totally different, and often quite spectacular. Since these businesses can add tons of revenue with very little new capital needed, you should see a rapid and, importantly, sustained increase in capital turnover. Revenue growth just massively outruns the small increases needed in the capital base. That's pure scaling efficiency in financial terms.
Okay, so this is where it all starts to click together, but in a really counterintuitive way for traditional finance thinking.
Right.
You've got these low margins, maybe even shrinking ones, but then potentially very high or strategically managed asset utilization. Our sources suggest the DuPont identity is kind of the perfect way to see how this structure creates value.
Absolutely. DuPont breaks down return on invested capital, ROIC, for us. The basic formula is ROIC equal NOPAT margin times capital turnover. Now, for your typical blue chip company, investors love seeing a nice, fat, stable NOPAT margin. High profit per sale, that's usually the goal.
But SES flips the script, hasn't it? The NOPAT margin is intentionally kept low. That's the shared part, right? The value given back to the customer.
Precisely. Which means, mathematically, the capital turnover part has to be exceptionally high to compensate and deliver a decent ROIC overall. That's where they win. They make up for those paper-thin margins by just maximizing the sheer speed and volume of sales and using their assets incredibly efficiently. They generate strong returns not by making a lot on each sale, but by making a little bit on a huge number of sales, processed very, very efficiently.
It really feels like the ultimate test of how good management is operationally. They have to be brilliant at execution day in, day out to make that trade-off work. Offsetting that margin they deliberately give away. It's maximizing flow, like you said, not just profit percentage.
It absolutely is. So if you find a company that consistently posts strong ROIC, but its NOPAT margin is down in the low single digits, you've likely found a business engineered for velocity. That's the financial crack letting the light in.
Okay, so given this intense focus on velocity and low margins, where does this SES strategy actually make the most sense? It can't work everywhere, surely.
No, definitely not. The research generally points towards B2C markets being more fertile ground, places where customers are really sensitive to price, or maybe where the product is a big chunk of their total spending. In a lot of B2B situations, things like reliability, service levels, the hassle of switching suppliers, those often matter more than just the rock bottom price. So the incentive for the supplier to give away all their margin is just lower.
Right. And we should probably contrast this directly with the opposite strategy, shouldn't we? The differentiation model. Some of the analysis we looked at, like Mobu-san's work, notes that differentiation, building a unique brand or product, charging higher prices, getting higher margins, even with lower turnover, is often seen as maybe more sustainable for value creation over the really long haul.
That tension really gets to the heart of the key risk with SES. You're making a very long-term bet. You are deliberately giving up profits today for the promise of this unshakable market share and high-volume dominance tomorrow. But if something disrupts that future, a new technology, a big shift in what customers want, maybe even regulation, if that long-term growth story gets cut short, the whole strategy might just fail to deliver the payoff. The sacrificed profits are just gone.
That's a perfect lead into the case studies. Let's start with the big one, Amazon. Lots of critics now say Amazon has kind of done a U-turn, right? They're raising prices, increasing their take rate from sellers. Have they just abandoned SES?
Amazon. It's the perfect, messy, real-world example to test these ideas. Is it structural SES or was it just tactical?
Yeah.
Okay, so yes, prices have gone up in places. But often, those increases come alongside huge additions to the value offered. Think Prime Video, same-day shipping, just the sheer convenience factor. So the counter-argument is, maybe it's still a variant of SES if the customer's overall willingness to pay for the whole Amazon package deal has gone up even more than the price hikes. They still feel like they're getting a bargain because the scale delivers so much extra stuff.
And there's the competitive angle, too. Early on, those low margins definitely acted like a wall, didn't they? Keep competitors out. I remember Nick Sleep's partner, Zach, talking about that. And Bezos' famous line, "Your margin is my opportunity."
Exactly. They use low margins as a weapon. But Amazon also made a massive strategic shift, a capital trade-off. They started out relatively capital light, mostly a website. But then they made the deliberate choice to become incredibly capital heavy, pouring billions and billions into building that enormous fulfillment network. Warehouses, trucks, planes.
Right. And that move, building all that physical infrastructure, that must have hammered their capital turnover for a while using the framework we discussed. Looked inefficient on paper.
It absolutely did, temporarily. But what did that investment buy them? It cemented their competitive moat. It made 2-day, then 1-day, then same-day delivery possible at scale. So they traded some short-term capital efficiency for incredibly durable, long-term market power. That's a classic SES-style strategic reinvestment, using capital spending to secure competitive advantage, even if it dents a metric temporarily.
Okay, let's pivot to maybe a cleaner, more explicitly SES example. Wise, Pullock, the international money transfer company.
Oh.
They seem quite pure in their approach.
Yes, Wise is a fascinating case. They are very upfront about it. They explicitly cap their operating margins, targeting something like 15 to 20%. And they publicly promise to pass all the benefits they get from scale back to their customers in the form of lower fees over time.
Which really highlights the core dilemma for investors, doesn't it?
It does, beautifully. With Wise, you're constantly forced to ask, are they being too nice to customers? Are they leaving enough on the table for shareholders? Is that virtuous cycle, that flywheel, generating enough extra volume and customer loyalty to actually justify permanently capping the margin like that? It's the central tension.
Yeah, it makes forecasting the future payoff really tricky. Management has to balance all these stakeholders. And for us trying to analyze it, we have to predict whether that high-volume future will really materialize and be worth the years of disciplined, self-imposed low margins.
So let's try and tie this together for you, the listener. If you want to screen for potential SES candidates, we've kind of landed on 4 quantitative criteria to look for.
Okay, first, gross margin stability. Look for that anchor. Margin staying flat or even slightly down even as revenues climb. Second, deliberate margin management. Operating margins, no-pat margins, look kind of low, maybe even contracting during growth phases because they're reinvesting heavily.
Third, contextualized capital turnover. You need to analyze the trend based on the business type. Are you seeing those strategic, lumpy investment dips in a capital-heavy business? Or that steep, sustained rise in a capital-light one? Context is key.
And fourth, the Duton test. Check how they generate their ROIC. Is it overwhelmingly driven by super high capital turnover, making up for that intentionally low no-pat margin?
Right, but remember, that quantitative screen, that's just the starting point. That's the map. The real work, the real investor homework begins after you find a potential candidate. Then you have to dig into the management culture, really understand their long-term vision, and critically assess how durable that customer value proposition, that flywheel, truly is.
Okay, so here's a final thought for you to chew on as we wrap up. We talked about how SES seems most common in B2C, but think about that contrast. The high margin differentiation model versus this high velocity SES model. Could there be a B2B industry one where switching costs are traditionally really high, where an SES approach could still be revolutionary, but maybe focused not just on cutting the initial price, but on radically reinvesting scale benefits into, say, lifetime service or incredible warranties, things that lock customers in through value after the sale? How might that kind of crack in the standard B2B model let the light get in? Something to ponder.